All right, now we're going to talk a little bit about government stimulus, and these are mainly payments to individuals and either loans or payments to large and small businesses. So we talked about before, the stimulus is well over $2 trillion now, and what this diagram shows is kind of how that 2 trillion plus is divided up in terms of support to different sectors of the economy. And you can see about 1/4 of it is going to larger businesses and local governments in terms of loans and other financial assistance. And then large pieces going to direct payments to families, tax cuts. So these are where they're actually going directly to consumers and taxpayers. And then support for other institutions such as hospitals and healthcare, which is another area that's under a great deal of stress now. I mean, the healthcare business has always been, pretty much a cost plus business, unlike property and casualty. And this kind of incredible need for healthcare and healthcare facilities is unprecedented, as far as I know, in recent history. And then we also have loans for small businesses, which a lot of these things are designed to either be a loan, but if the small business or business maintains certain levels of employment, then the loan becomes more of a grant. So it's gradually forgiven as long as the business meets certain objectives, such as I said, maintaining employment. Last are expansion of unemployment insurance, which Doug talked about. So we're seeing an unprecedented nationwide unemployment insurance, which is normally tied to states, and states set the level of unemployment insurance compensation. The government has created a 4-month program where everybody's going to get at least $600 a week, which is quite a bit higher than most state benefits. Anything you had to say, Doug?
Yeah, just, and it's implicit what you said, Jack, but in some cases, unemployment benefits might be higher than salaries. And they opened that is the legislation passed by Congress, opened the potential beneficiaries of the unemployment compensation to groups that were heretofore not able to participate, so that freelancers and even the self-employed, who historically have not been able to collect unemployment, are actually eligible for the programs created by the legislation passed and signed in the last week.
Well, I think they're recognizing that in the overall economy, the self-employed and freelancers have become a very significant part of that. And if you just have employment programs that are targeted at, traditional workers and more traditional businesses, then you're going to be missing a large segment of the population.
Oh no, I agree 100%. The so-called gig economy has resulted in some contribution to the increase in employment and the very low rates of unemployment. And if those groups were not included, there'd certainly be a large number of people that were missing the support for the lost income that historically had not been available to those groups.
Yep. Okay, and then the effect of the stimulus has been pretty dramatic. And what we're looking at here is going back to January, the weekly changes in each of the main US indexes, the S&P, the Dow Jones, and the NASDAQ indexes. Once again, these are just weekly changes, not cumulative changes over the period. And so what we see is that, not too much going on in January and February, and then at the end of February, the market is sort of waking up to the potential losses from COVID shown on February 28th, where all of the indexes were down more than 10% that week. And then a slight rebound, a little bit of hope. And then once again, after that, all the indexes down a little less than 10%, and then down more than 15% in that week. But then last week we had a rebound of anywhere from about 9 to 13%. And the thing to keep in mind here is that if you look at these on a cumulative basis, the drop in the market through March, the week of March 20th, was about 30% or so in each of the indexes. And now that we've gotten an increase of around 10% last week, we're still down around 20%, which is the traditional dividing line between a bear market and just, a sell-off, a regular sell-off. Doug?
Yeah, nothing really to add other than, again, what's probably implicit for any people that are parsing your words. We're probably in a high volatility period for a protracted period of time. Not to get too wonky, but the VIX, the volatility index, for a good chunk of years, until a few years ago, was probably between 10 and 15%. And the volatility index has been up in the range of 60 to 80% more recently. Now, I'm not going to try to define all that in detail, but the fact that the volatility index is up by 6 or 8 times or 5 to 8 times what it had been indicates that the market is anticipating relatively high volatility for the foreseeable future. Volatility is not going to be something in the rearview mirror because it's going to be a long while before we really know what the outcome of the full incidence of COVID-19 and how effective and how long it will take for them to be effective is going to be the case for all of the economic policies governments around the world are putting in place.
Yeah, there's definitely a lot of fear and uncertainty in the market. And the VIX, as you said, had gotten up into the high 80%. And then I think its lowest it's been recently is down in the 50s, but historically unusually very high, unusual levels of volatility. Okay. Right now, looking at the real economy.
Yeah, so more Fed actions, because while the Fed historically has tried not to involve itself directly in the real economy, they try to influence the real economy through their more traditional monetary policy actions. But following up on some of the programs put in place in the aftermath of the 2008 financial crisis, and even going beyond that, the Fed is getting directly involved in acting in a way to support players in the real economy. Now, one of the Fed's, or more generally central banks' responsibility has always been a lender of last resort. So in the normal run of things, they're responsible for trying to influence the course of the economy through the traditional monetary policy tools. But in a financial crisis, and that was literally why the Fed was created, to fight financial panics, they become the lender of last resort. Traditionally, primarily to financial institutions, but when necessary, to real economy players. So that top point is actually playing off one of the earlier slides that was showing the division of the $2.2 trillion of fiscal stimulus. Part of that is, well, it says here $300 billion loan/subsidy program. So that's that loan that might turn into a grant program to be available to small businesses. So the Treasury has actually transferred $30 billion to the Fed, which the Fed will use to lever up to as much as $300 billion of loans to try to support employers, consumers, and businesses. And these are loans that the Fed will not make directly, but they will oversee a program through the Small Business Administration, the SBA. And the SBA itself doesn't directly make loans, but they oversee historically commercial banks that had qualified for an SBA lending program. But to encourage a wider casting of the net, they have opened up the application to participate in this lending program to any FDIC, Federal Depository of Insurance Corporation, that is, FDIC insured bank, credit unions, or even financial technology, fintech lenders. So they're trying to make loans as readily available as possible. And while this $300 billion is what was announced by the Fed, this morning I saw an article where an interview of Steve Mnuchin, the Treasury Secretary, was touting that this could be as much as $350 billion. So they're hoping to get a lot of money into the hands of businesses and consumers that way. But then in addition to the support to the secondary market for corporate bonds, the Fed, through a special purpose vehicle, is also going to buy new issues of corporate and municipal bonds, again, investment grade, but also through the special purpose vehicle, make loans to investment grade corporate and municipal borrowers. And one of the things the Fed is doing outside of the direct expenditure is they're using their so-called jawboning. That is, they're talking to the commercial bank lenders to ease up on the way they're policing their loan portfolios. The Fed has a significant role as a bank regulator, and this is a sort of the parallel to the encouraging banks to borrow at the discount window to get more reserves into their hands. The Fed is telling banks to forbear a little bit more. Don't try to foreclose or force a borrower into default simply because they've missed a loan payment or an interest payment. And as a way of trying to emphasize that, that forbearance they're trying to encourage, the Fed has done a couple of things. They're suspending the bank regulatory capital requirements for some period of time. I believe it's at least for the next 6 months, so banks don't have to meet a reserve requirement. And in addition to that, whereas normally as soon as a bank recognizes that a loan is not performing, they have to write down the value of that loan from whatever the principal amount was to what they think they'll ultimately be able to recover. Those write-downs used to have to occur as soon as the loan was recognized as being non-performing. That is, a borrower had missed some specified number of payments. The Fed is now telling banks they don't have to write down non-performing loans for up to 2 years as a way of emphasizing that forbearance for delinquent borrowers that the Fed is trying to encourage. Because historically, at least, financial panics in part impacted the real economy by a contraction of credit as borrowers defaulted and their loans were foreclosed on or pushed into default. And the Fed is trying to defer that or prevent that sort of credit contraction from happening, both by making money available to the borrowers and then encouraging the lenders not to place the payments with the normal rectitude that the Fed usually encourages.
Very good point. Yeah, relaxing the reporting of non-performing loans and taking those credit losses, for originally immediately, and now they're not going to have to recognize them for 2 years, will have a big impact on, what kind of profits and performance the banks will show.
Well, I think that Jack, this is actually a recognition of that very issue contributing to the contraction in 2008, because those rules of immediate write-down were in place, and as assets were written down, the banks were short of capital, so they have to sell assets to get capital, but the asset sales were forcing even further down the market prices of those assets, forcing them to have to take additional write-downs, et cetera, et cetera, et cetera. So I think the Fed's actions are wise in the way they're trying to short circuit that sort of self-reinforcing contraction of credit in the economy and the contraction that forces on the real economy.
Yeah, absolutely. All right. So now let's look at the prospects for the U.S. economy and also equity markets, and look at some of the changes that have occurred in those markets. So the first is a shift in investors' risk tolerance. So as Doug was saying, and I was saying also, you've seen really large increases in credit spreads, much higher volatility in the equity markets, a big drop in prices of riskier debt, big drop in equity prices that we saw, more than 30% a little over a week ago. It's just showing that investors are, kind of pulling back quite a lot, a complete flip in terms of investor sentiment from the end of last year. We saw, stock markets reaching records, just a real willingness to take risk. And now that we're seeing kind of a shift in that, this is going to have a big impact on the value of riskier assets like equities and non-investment grade debt. One other aspect that has been talked about is that the companies that are taking loans and possibly grants under some of these programs by the Treasury and the Fed, that they're talking about limiting those companies' ability to buy their shares back. And this is something that has a lot of popular political appeal, but we have to keep in mind that share buybacks have been the main support for the market for the last 8 or 9 years. So share buybacks, or companies buying their own stock back, has been the major demand in the equity markets, and net really the only demand net in the equity markets for quite some time. So if you start limiting buybacks, you'll do two things. You're going to eliminate a natural support for the market, a natural source of demand. You're also going to divide the market into two types of companies. Companies that are accepting government assistance, generally companies that are experiencing a lot more adverse conditions in their market and their businesses, and then companies that have actually done very well or have remained stable during the COVID crisis. Companies like Apple, although they've taken some hits, Amazon, Zoom, companies like that. And so you're going to create two tiers of companies in the market. Those that may have already had problems, had to borrow money or take money from the government and now cannot buy their shares back, and then those that have not really had very many problems, who are actually quite cash rich and will continue to buy their shares back. I don't know if you had a view on that, Doug.
No, I would maybe just to reinforce some of the things you said about the cash-rich firms, even some that have had difficulties. You'd mentioned Apple, for instance, had shuttered all their stores in China for over a month, and they just reopened them in the last week. And then in the last week, Apple shut all of their Apple stores outside of China. So clearly Apple's business has been adversely affected, to say nothing of the disruption to its supply chain, given that so much of their assembly and production of the components of Apple hardware is done in China. But Apple's sitting on about $100 billion of net cash. That's cash and short-term investments in excess of the debt on their balance sheet. So even those companies adversely affected in terms of their operating performance, as long as they're cash rich, whether it's an Apple or an Amazon or a Facebook or a Google or whoever, per your comment, I think there'll be a pretty significant tiering in performance of the companies that can't buy back their stock versus those who can, who are in many cases likely to view this as a buying opportunity, retiring equity at relatively low cost, and thereby reducing their weighted average cost of capital to enhance the value of the equity going forward.
Yep. And the last thing I wanted to mention just briefly was looking at private equity and also private debt, which are pretty much intertwined. So private equity are companies that are held by either private equity firms or have been taken private. And generally they were acquired using lots of debt. It has gotten to be a lower percentage recently, more like 60%. It used to be 70 or 80% debt. And there is some concern that as lenders decide to pull back from lending to companies like this, the leveraged loan market and the private lending market may cause some failure of some of these companies and potentially a liquidation of these private equity holdings. So I didn't know if you had anything.
Just to support what you said, Jack, several of the market segments you identified that were under pressure, both the high yield debt market, because sometimes the buyouts are funded in part by issuance of high yield bonds, and the leveraged loan market. Those are where a lot of that ended up in the hands of investors. And to the extent that either of those market segments come under pressure, that could result in some much more rapid than anticipated liquidation of some of these private equity investments. So I don't think we've seen too much pressure there yet, but if those market segments worsen and there are not Fed or other programs that support them, it ultimately might force some fire sale of private equity interests in companies that had been acquired by private equity investors.
Yep. Okay.